Preparing for a financial analyst at Migros interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to work as a financial analyst at Migros? Migros appeals to me because it combines commercial scale with a clear cooperative purpose. A financial analyst can influence practical decisions, such as pricing, assortment, store investment, and supply chain efficiency, rather than only reporting historical results. I would bring strong Excel, financial modeling, and communication skills, while learning the economics of retail in greater depth. The role also fits my interest in turning operational data into recommendations that improve customer value and sustainable profitability. While answering, connect your analytical skills to Migros's retail scale, cooperative purpose, Swiss market presence, and need for disciplined decisions across stores, products, logistics, and digital channels. Question 2. What are the most important financial KPIs for a retailer like Migros? I would prioritize like-for-like sales growth, customer traffic, average basket size, gross margin, inventory turnover, shrinkage, labor cost, EBITDA, and operating cash flow. The right KPI depends on the decision. Traffic and basket size explain revenue, while margin and waste explain gross profit. I would also compare stores, categories, and online channels, because consolidated performance can hide weak units. Ultimately, I would link operational KPIs to profitability and cash generation rather than reviewing them in isolation. Make sure to cover sales growth, like-for-like revenue, gross margin, inventory turns, shrinkage, labor costs, EBITDA, cash conversion, customer traffic, basket size, and channel profitability. Question 3. How would you build a monthly sales forecast for Migros? I would begin with historical sales by store, category, and channel, then identify seasonality, holidays, promotions, price changes, and calendar effects. Next, I would forecast volume and average selling price separately, incorporating planned campaigns, new stores, closures, and online growth. I would challenge assumptions with commercial teams and compare the forecast with recent run rates. After month end, I would analyze forecast errors and update the model, improving accuracy through a documented rolling process. In your answer, talk about historical trends, seasonality, promotions, holidays, store openings, price changes, volume assumptions, online demand, management input, and variance-based forecast updates. Question 4. Explain the difference between a budget, forecast, and actual result. A budget is the approved financial plan for a defined period and usually sets targets for revenue, costs, investments, and cash. A forecast is a refreshed estimate of what will actually happen, using current information and changing assumptions. Actuals are the recorded results from the accounting system. At Migros, I would compare actuals with both budget and latest forecast, explain operational drivers, and recommend actions when performance indicates that the original plan is no longer realistic. Be sure to mention that budgets establish approved targets, forecasts provide updated expectations, actuals record performance, and variance analysis explains differences and supports corrective actions. Question 5. How would you analyze a gross margin decline in a retail category? I would first quantify the decline by category, store, product, and period, then separate price, volume, and mix effects. I would investigate supplier cost increases, promotional discounts, markdowns, waste, shrinkage, and changes toward lower margin products. I would also compare realized margin with the planned margin and benchmark similar locations. If the issue is structural, I would recommend pricing, sourcing, assortment, or promotion changes. If temporary, I would explain the timing and expected recovery. Focus on price and volume mix, promotions, supplier costs, markdowns, waste, shrinkage, foreign exchange, product mix, and whether the decline is temporary or structurally changing. Question 6. What is working capital, and why is it important for Migros? Working capital represents the short-term funds tied up in operations, commonly measured through receivables, inventory, and payables. For a retailer, inventory is usually the largest operational consideration. Too much stock consumes cash and increases markdowns or waste, while too little creates stockouts and lost sales. I would monitor inventory days, supplier payment terms, and cash conversion alongside service levels. Improving working capital should release cash without damaging product availability or supplier relationships. In your answer, define receivables, inventory, and payables. Explain cash tied up in operations, and connect inventory availability, supplier terms, stockouts, waste, and cash conversion. Question 7. How would you evaluate whether a Migros store should be renovated? I would compare the store's expected performance with and without renovation. The model would include incremental sales, gross margin, labor and energy savings, refurbishment costs, temporary closure effects, cannibalization from nearby stores, and working capital impacts. I would calculate payback and NPV using an appropriate discount rate, then test downside cases for lower traffic, cost overruns, and delayed completion. I would also consider customer experience and strategic location value, because financial returns should support the broader investment decision. Mention incremental sales, gross margin, operating costs, investment outlay, cannibalization, payback, NPV, customer experience, disruption, and sensitivity to demand and construction assumptions. Question 8. Walk me through a variance analysis you have performed. In one analysis, operating expenses were above budget by approximately 8%. I built a bridge separating headcount, wage rates, temporary labor, utilities, and timing effects. The main driver was temporary staffing during a period of unusually high absence, not uncontrolled recurring costs. I confirmed the explanation with operations, updated the full-year forecast, and recommended tracking absence-related labor separately. That approach converted a broad variance into a specific management action and improved the next planning cycle. Make sure to cover the original expectation, actual outcome, quantified bridge, root cause investigation, stakeholder validation, corrective action, and how the analysis improved future forecasting. Question 9. How would you assess the profitability of a promotion? I would establish a baseline using comparable periods and control stores, then measure incremental units, revenue, and gross profit during the promotion. The calculation should include the customer discount, supplier funding, cannibalization of other products, waste, and any extra labor or logistics costs. I would also examine post-promotion sales to identify stockpiling or lasting customer behavior. A promotion is successful when incremental contribution and strategic benefits outweigh the margins sacrificed on discounted items. Discuss incremental units and revenue, baseline sales, discount cost, supplier funding, gross margin, cannibalization, halo effects, waste, post-promotion demand, and customer retention. Question 10. How do the income statement, balance sheet, and cash flow statement connect? Net income from the income statement increases retained earnings within equity, while balance sheet changes explain how resources and obligations evolve. The cash flow statement starts with profit, removes non-cash items such as depreciation, and adjusts for working capital movements before showing investing and financing cash flows. For example, inventory growth can reduce cash even when sales and profit increase. Reviewing all three statements together prevents me from confusing accounting profitability with liquidity. Be sure to explain profit flowing into equity, balance sheet movements affecting cash, non-cash expenses, working capital, capital expenditure, and why all three statements are needed together. Question 11. How would you analyze inventory performance across Migros stores? I would segment inventory analysis by store, category, product type, and channel, because fresh food and durable goods have different economics. Key measures would include inventory days, turnover, sell-through, stockout rates, waste, shrinkage, and gross margin return on inventory. I would investigate slow-moving products, forecast errors, replenishment settings, and supplier lead times. The goal is not simply minimizing inventory, it is achieving reliable availability while reducing cash tied up and avoidable losses. Focus on inventory days, turnover, sell-through, availability, stockouts, waste, shrinkage, category differences, replenishment accuracy, and the trade-off between service levels and cash efficiency. Question 12. What would you include in a business case for expanding online grocery sales? I would model customer adoption, order frequency, average basket, gross margin, delivery fees, picking labor, packaging, fulfillment infrastructure, technology, marketing, and customer service costs. I would distinguish incremental online sales from purchases transferred from stores, then calculate contribution margin and cash investment. Sensitivities should cover delivery density, labor productivity, substitution rates, and customer acquisition cost. I would recommend expansion only where scale can improve unit economics without weakening store performance or customer experience. Mention customer demand, incremental revenue, basket size, fulfillment, delivery costs, technology, labor, marketing, cannibalization, contribution margin, investment, and scenario analysis. Question 13. How would you use Excel to support a financial analysis? I use Excel to organize source data, build transparent assumptions, and create repeatable calculations rather than relying on manual edits. Typical tools include XLOOKUP, SUMIFs, pivot tables, charts, scenario switches, and reconciliation checks. I separate inputs, calculations, and outputs, document key assumptions, and test unusual results. For a retail analysis, I might build a store-level profitability model that rolls into regional and group totals, allowing management to examine both drivers and scenarios quickly. In your answer, mention data cleaning, structured assumptions, formulas, pivot tables, checks, scenario controls, visualization, documentation, and protecting the model from input and linkage errors. Question 14. Tell me about a time you found an error in financial data. During a reporting exercise, I noticed that one region's expense ratio moved sharply despite stable activity. I reconciled the source file to the ledger and found that a duplicated upload had overstated logistics costs. I quantified the impact, informed the reporting owner, corrected the file, and reran the management pack. I then added a duplicate record check and a total to ledger reconciliation before submission. The experience reinforced that analytical judgment and basic controls are equally important. Be sure to describe the control or reconciliation, the investigation, materiality assessment, correction, communication, root cause, and preventive measure introduced afterward. Question 15. How would you prioritize competing requests from commercial and operational stakeholders? I would rank requests by decision impact, deadline, financial materiality, and dependency on other work. A board submission or pricing decision would usually take priority over a low-impact enhancement. I would clarify the required output, agree timing, and communicate trade-offs early rather than silently missing deadlines. When data is incomplete, I would provide a clearly labeled preliminary view with assumptions, then refine it. This keeps stakeholders moving while preserving analytical credibility. Discuss urgency, decision impact, deadlines, data availability, materiality, dependencies, stakeholder alignment, transparent communication, and delivering a useful first version before refining detail. Question 16. What is the difference between fixed and variable costs in retail? Variable costs change with activity, such as merchandise purchases, payment fees, and some distribution expenses. Fixed costs, such as rent and certain salaries, remain relatively stable within a relevant operating range. Retail also contains semi-variable costs, including labor that rises in steps as opening hours or volume increase. Understanding behavior helps calculate contribution margin, break-even sales, and operating leverage. I would validate classifications with operational owners because accounting labels do not always reflect economic behavior. Explain cost behavior, store rent and salaries, product costs and transaction-linked expenses, semi-variable costs, contribution margin, operating leverage, and limitations of simplistic classifications. Question 17. How would you investigate declining sales in a group of Migros stores? I would decompose sales into traffic, conversion, average basket, price, and volume, then compare affected stores with similar control locations. I would review assortment availability, competitor activity, promotions, store condition, service levels, local demographics, and online substitution. The timing matters. A sudden decline may indicate execution or supply issues, while a gradual decline could reflect changing customer behavior. I would combine data with store manager interviews and propose targeted actions supported by quantified potential. Cover traffic, basket size, price, volume, assortment, competition, service levels, local demographics, online substitution, promotions, store condition, and comparisons with control locations. Question 18. What financial considerations matter when comparing suppliers? I would compare total landed cost rather than headline purchase price. That includes rebates, payment terms, transport, minimum order requirements, quality-related waste, lead times, and expected service levels. I would also consider currency exposure, concentration risk, and the financial cost of stockouts or supply disruption. A cheaper supplier may be less attractive if reliability reduces sales or increases waste. My recommendation would show both the base case and risks, not just a single unit price comparison. Mention purchase price, payment terms, rebates, logistics, quality, minimum orders, lead times, waste, reliability, currency exposure, total landed cost, and business continuity risk. Question 19. How would you explain a complex financial finding to a non-finance manager? I would start with the business question and lead with the conclusion, avoiding accounting terminology unless it adds value. For example, instead of saying margin deteriorated due to mix variance, I would say customers bought more lower margin products, reducing profit by a specific amount. I would use a simple bridge or chart, identify the operational cause, and recommend an action. I would then invite questions and confirm that the manager understands the decision and trade-offs. Focus on the business question, plain language, one clear conclusion, quantified drivers, visual evidence, implications, recommended action, and checking that the audience understands the decision required. Question 20. What would you do if a senior manager challenged your analysis? I would treat the challenge as an opportunity to test the analysis, not as a personal disagreement. I would ask which assumption or data point concerns the manager, then revisit definitions, source data, calculations, and timing. If I found an error, I would correct it immediately and explain the impact. If the analysis remained valid, I would show the supporting evidence and sensitivities respectfully. The priority is a reliable decision, not winning an argument. Be sure to mention listening carefully, separating facts from assumptions, checking data and definitions, remaining objective, revising errors transparently, and defending conclusions respectfully when evidence supports them. If you are still with us, congratulations! You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.